Yeah, welcome back, my dear friends. Welcome back. Now, so before break, we were discussing about method B, which is departments which are not interdependent but centralized purchase. So, unlike than other models like A and C, so in this model, we're supposed to prepare departmental trading account to find the departmental profit. We have to prepare. It is not a directly departmental trading account. In spite of that, instead of that, we have to prepare three different ledger accounts for different departments because it's a centralized purchase and centralized distribution. So therefore, each department, so at what rate and how much stock and at what loading and how much profit they have earned in order to keep a track, we have to prepare independent ledger accounts in detail. Correct. So that is one is departmental stock account, another one is departmental markup account, another one is departmental profit and loss account. So departmental profit and loss account of all for each department three ledger accounts. So finally, that departmental profit or loss will go to general P&L account as same. Got it? So let's go for general entries. Let's go for general entries. I will hide the video. Yes. So, friends, can you able to hear me? So there is no response. Can you able to hear me? Yes. Yes. Thank you. Thanks for responding in a group. Let's go. First entry, journal entries. Journal entries to start with. Entry number 1. Entry number 1. Departmental purchase. Entry number 1. It is departmental purchase. Departmental purchase. So if it is a department as purchased, even though it's a department as purchased, it is like centralized distribution. That is head office or head of centralized department, it would have been informed or ordered to supply directly to the respective department. So even though it's a purchase from individual department, we will record as if it is supplied from the head. That's a centralized system. Entry is memorandum stock account. Imagine purchases means it's a stock. Stock comes in. If stock comes in, stock will increase. Therefore, stock account has to be debited. If sales made, stock will go out. Stock will go out that time. When the sales is made, stock will reduce. So for the moment of stock, we have opened, that is a departmental stock account we have to open. So therefore, keep in mind, whenever stock comes in, departmental stock account will increase debit. If the stock goes out, departmental stock account will be reduced. That's a credit. Now, so here, entry, departmental stock account debit. Departmental stock account debit. Account debit to cash or bank or creditor account to departmental markup account to departmental markup account. Now, so departmental stock, this is either memorandum departmental stock account or departmental stock account, both are same. So here, this has to be recorded at invoice price. Therefore, departmental stock account at IP or marked price, including margin. Next, cash. Suppose if you have some customer, you would have purchased for 100 rupees and you would have sent to the department at 150, for example, 150 rupees. Correct? So now, if it is a purchase, means normal entry is purchase account debit to creditor or cash or bank account. If it is a cash purchase, cash account will be credited. If it is a credit purchase, means creditor account I supposed to write. But for him, we have to give only cost, not the profit also. Correct? So therefore, only cost. So therefore, here what will come? It is cost, and the markup account is markup or loading will be there. So this will be, this prices has to be recorded. So departmental markup, departmental stock account will appear at invoice price. Keep in mind. Next, let's go to the entry number 2. Entry number 2. Entry number 2, sales. Entry number 2, sales. Entry number 2, sales. Entry number 2 is sales. Now, in the sales, my dear friends, we have a 3 types of sales. In the sales itself, we have a 3 situations. We have a 3 situations. Therefore, from sales, please divide your page into 3 parts. So 3 entry will come. So therefore, 3 parts. Sales. Yeah. So sales at department. Sales at department. So first option is, my dear friend, sales at marked price. Marked price. That means in other way, sent price. That is at what price I have sent to you, at the same market price. If you sell, then it is sales at market price. There is no plus or minus to be done. So it is sales at market price. At what price I have sent, at the same price. If you sell, this entry will come. Got it? Next is. So this is sales, means actual sales. Next is actual sale. Actual sale price. Actual sale price is greater than market price. Market price. Greater than market price. That is higher than I sent. Suppose if I sent at 150, 100 rupees the cost, 50 rupees I added, and market price is 150. That's the sale price, and I informed the department to sell at 150. Suppose if they have sold at 160, that is beyond my market price. That situation. Next is actual sale price. Actual sale price is less than market price. Less than market price. Less than market price. Correct? So here, so for if you want example, you can take it here. So departmental stock. Suppose if I have sold at example market price is 150. 150. So that is cost is equal to 100. So plus markup 50. So therefore market price is 150. Market price is 150. Just example, just I'm saying. Now, if he also sold the goods at same 150, then it is called as sales at market price. Sales at market price. So now, whatever the value I sent, at the same value if he sent, there is no additional profit or loss to be plus or minus. Correct? Already at that price, look out, markup in our case here, market price is, for example, 150. Cost is 100. I will pay to the outside cash or credit. So balance 50 rupees. I have already recognized in a markup account as a profit. That is, if I sell this goods at 150, I will get 50 rupees as a profit, which already I have credited in a markup account. Therefore, nothing to increase or decrease at the time of sale at market price. Yeah. So just here, you have to pass an entry as if, since it is a sales, stock is going out. Therefore, departmental stock will reduce. To that extent, debtor or cash, that is, it's like sales. Therefore, either I have to receive the cash or bank, or debtor account has to be debited if it's a credit sale. So therefore, entry in the first case, bank account debit. So bank or debtor account debit to departmental stock account. Departmental stock account. This is usually it is at market price. Therefore, there is no profit or loss to be recognized additionally, because on this, to this extent, profit already we have taken to departmental markup account. So therefore, no plus or minus. So example here, 150 as it is. Next, let's go to the actual sale price is more than market price. So example 160. Example 160. Now I have sent already to the, I have sent at 150. Therefore, I thought he will sell at 150. Therefore, on that 50 rupees markup, I already recognized in a markup account. Correct? Now he has sold at 160. That is a 10 rupee extra. So that means that a 10 rupee extra still, which I have not accounted in my book. That is the 10 rupee profit I have not recognized in my book. Therefore, in the loading account, the 10 rupee I have to increase. Correct? So therefore, entry bank or debtor account debit. So sale price. 2. Departmental stock account. Departmental stock account to the extent of market price. Extra, whatever the 10 rupee we earned, the 10 rupee we have to credit to departmental markup account. Markup account. So which amounts to here, look out, 160 we sold to the customer. Therefore 160 we supposed to receive either cash or credit. So then departmental stock account is, it is always at markup price. So therefore it is 150. I will reverse invoice price. Balance 10 rupee. Additional profit I have to credit to markup account. Additional profit I have to credit to markup account. I have to credit to markup account. Yeah. Next, let us go to the third event. Suppose if actual sale price is less than market price. Yeah. So I example, let us keep it as example. So 135. Example 135. Got it? I thought I invoiced this goods to sell at 150. Correct? But there actually for a customer he has sold at only 135. So that means 15 rupees what I expected in a margin, it was reduced. So therefore, in my book, I thought if I sell these goods at 150, I will earn 50 rupees as a profit. So that's why I already recognize the income in my markup account as a 50 rupees as my loading. Correct? But here actually sale price was sale price is at 135. Therefore, actually I made a profit of only 35 rupees, not 50. Therefore, that extra 50 rupees I have to reverse. Extra 15 rupees I have to reverse. Therefore, P&L, departmental markup account has to be debit. So it is like P&L account, my difference, but only for profit. Keep in mind. If it is profit is increased, whatever profit is there, that I will credit in a markup account. If I sell at same price, there is no plus or minus, additional profit or reducing the profit. If it is more than that, I have to increase my profit. Therefore, I have to credit the loading account. If I have sold less than that amount, then I have to reduce that loading. So that's fine. So here entry. So bank or debtor. Bank or debtor account debit. It is usually at sale price. Departmental markup account debit because I have to reduce the margin. So therefore, departmental markup account debit. Therefore, departmental markup account debit. So this is for that 15 rupee difference. To departmental stock account. This is always at sent invoice price. So therefore, sale price is 135 actually. Reduce in a markup is 15 rupee. Therefore, in a departmental stock at 150 rupees at invoice price, I have to always IP invoice price I have to credit in. When goods are received, I have to debit at markup. So I have to increase at market price sales price. If goods are going out, I have to eliminate at same price. Yeah. So friends, are you understanding this sales entry? This is sales entry. This is sales. It depends on like individual customer. Not in total, my dear friends, not in total. It is like individual customer. So I sent to sell at 150, correct? Suppose if a valuable customer is there, suppose a known customer is there, so therefore some concession you have given. It is not available for everyone. For few customer, actual, that's why we have taken actual sale price. It is not completely reduced. It is only actual sale price. It is applicable for individual sales. Next, let's go to the event number 3. Event number 3. Now it is look out goods purchased and goods sold. Correct? Next, let's go to the other area. Goods damaged / destroyed / slash loss, which is nothing but abnormal loss. Correct? So that means here abnormal loss, if it is goods destroyed or damaged, whatever it might be, my difference. In this case, imagine there is no realization. That means bank or debtor, that account itself will not come because it is not realization. Not even one single paise it has been realized. Got it? So now here, if the goods are lost, my dear friend, look out. Goods are lost. Therefore, anyway from stock I have to remove because stock is not available. But stock anyway I have to remove. Correct? So therefore, departmental stock account, whatever I have credited, to this extent of stock I have to remove. So since the departmental stock account is appearing at invoice price, I have to remove departmental stock at invoice price only. Correct? So but in this stock I have a two component. One is cost component, another one is profit component. This profit, what we call it as markup. Correct? Suppose here 100 rupees is the cost, 50 rupees is the profit. Suppose if 150 worth of this stock has been destroyed or accident, fire, whatever it might be. Correct? So now departmental stock account I have to remove at invoice price. That's a market price. 150 I have to remove. So therefore 150 I have to remove from stock. That should be credited. Correct? So then this cost is there. This cost portion, since it has not realized. Correct? So this I have to charge to P&L account. Yeah. So departmental P&L account I supposed to charge. So this profit margin, this profit element, I have to reverse from departmental markup account. So in this loss, so please understand there are two components: cost component plus profit component. Eliminate. There's a markup component. So profit. So whatever cost is there, that I supposed to charge to P&L. Yeah, it is like bad debt or loss of stock, whatever it might be. So to the extent of cost, I will charge to P&L. To the extent of markup, since already created a markup, that I will reverse. So then in a departmental stock account, since stock, even though it is destroyed, I have to remove from the derecognized from the books of accounts. So therefore I will remove the stock. So therefore entry departmental P&L account debit within bracket. This is for cost. This is for cost component. This is for what? Cost. This is for cost. And departmental markup account debit. It is reversal of loading. Therefore, this is for loading slash markup. Then to departmental stock account, this is at invoice price. Therefore here I call this as market price, which is nothing but invoice price. Market price. Third entry is for goods damaged or destroyed. Next, let's go to the event number 4. Yeah, so event number 4 is very familiar to you guys because of corona season. So cost of goods are increased. Correct? Or in a normal trend, in a normal situation, suppose if the festival season, big bazaar. Correct? So Wednesday sale, clearance sale, etc. they will do. So that means what happened? So it is not individual customer discount, it is a flat discount. So what are all unsold all these days? So at a festival offer, everything has to be sold. Therefore, they will reduce the value. Otherwise, the goods will become expiry. Correct? Got it? So therefore, now this is here sales either at a cent price or less than or more than for the individual customer. Correct? It is not for everyone. That means stock is still appearing at its invoice price only. It is not a flat discount, flat reduction in the price. Correct? So whatever cent I have 150, stock is worth for 160 as it is 150 as it's appearing. Only for one or two customer, if the sale price is less than whatever I market price, then only I have to reverse that loading on particular customer or on that sale. Correct? Suppose if in an event number 4, it is a marked down during the year. marked down during the year. So it is like, my dear friends, reducing value while season correct. So example, clearance sale, flat reduction in price, Suppose earlier I said I sent the goods at, for example, 150 rupees I sent earlier, correct. But now what I did, so it is a flat reduction on this, so it is 20% off, correct. So now 20% on 150, so they will strike off, so 30 rupees is 150, that's a 20%. Now it is 120. Correct. But in a departmental stock account, it is appearing at 150. And in a loading it is appearing at 50 rupee. I will realize the profit, correct. If it is an individual customer, so only that alone stock I will not disturb because it is worth, correct. But now it is a flat reduction, complete sale price itself I reduced, so therefore now invoice price of the stock also I have to reduce or not, IP, correct. So therefore what I do now, since it is I reduce 30%, 30 rupees, since a profit I have reduced, always, my dear friends, look out at this, whatever the flat reduction in a value, even now look out, cost is 100. So out of this 120, cost is 100 and markup is only 20, correct. But I already recognized at 50, therefore this reduction in price is completely clearly is towards markup. Cost cannot be decreased, correct. Sale price, out of that, if you are marked down, if you are reducing marked down, means it indicates that you are reducing the profit. That is the meaning. So therefore, what profit you earlier you estimated 50 rupee, that I have to reverse, and also your stock value also, what you thought 150 rupees MRP, now it has to be reduced to 120. Therefore, there also 30 rupees you have to reverse. Loading also 30 rupees you have to eliminate. Therefore, entry departmental markup account debit to departmental stock account. Look out, only in a marked down during the year. This is what flat reduction. So then that time only I will touch the stock value to be reduced from invoice price. Yeah, if it is only for one customer, if it is a sale is less than or more than, so for that stock I will not disturb, let it be at invoice price. If it is a sale price is more than that, I will recognize as an income. If it is less than that, I will reverse the loading, correct. Only on a seasonal sale, when I reduce the markup in total, that time only markup also I will reverse, and simultaneously invoice price of the goods, there's a market price of the goods which is appearing at, that also I will reduce. Now look out, if I reduce here 30 rupee departmental markup on debit to stock account, if I reduce, now it is appearing at 120. Here my margin is only 20 rupee. That's what, 120. So out of this, look out, 120 is my invoice price, market price. Out of that, markup is 20 rupee, which is perfectly appearing. Have you understood this point? Marked down during the year. It is like seasonal flat reduction. Next, let's go to the event number 5. Event number 5, end of accounting year. Now we have to close the books of accounts. So now here we have to open only 2 accounts, my dear. 3 accounts. One is departmental stock, departmental markup for loading, and departmental P&L. So if expenses are there, it will come in departmental P&L. So therefore, expenses directly, it's a departmental P&L to bank or cash. So it will come to departmental P&L account. So now let's go to the first entry out of this. A, ascertain got shock. Ascertain and carry forward balance in departmental stock account. Departmental stock account hyphen represents unsold unsold stock at invoice price unsold stock at invoice price. So here, so just imagine I'm opening just three ledger accounts. One is departmental stock, second is departmental markup account. This is for loading. So then third one is departmental P&L account. This is how it will work. Correct? Now what you have to do, you have to balance departmental stock by balance carried down. So whatever you get, this stock is at invoice price, imagine, because this departmental stock is at invoice price, market price. Therefore, balancing figure what you get is invoice price. Yeah. Now let us go to the event number B. What you are supposed to do. So for this, no entry, my dear friend. This is just a balance, ascertain and carry forward. Therefore, this is balancing. By balance carry down, it is not entry. Next, B. Event B. Compute unrealized profit. That's a loading element on departmental closing stock. Closing stock and carry forward it in different departmental markup account. Yeah. So here example, let us take. So it is a 30 rupees is the stock. On that, imagine 20 rupees is the cost, 10 rupees is the profit. Correct? So here, suppose 50 rupees is the markup. Out of that, 10 rupees is unrealized profit. First, I have to value the closing stock. Correct? On that, so to balance carried down, I have to write 10 rupees. 10 rupees is unrealized profit, URP. So the 10 rupees I have to compute. What you compute, you have to write in departmental markup account as to balance carried down. So that means the balance out of 50, 10 rupees, which is on closing stock, if it is unrealized, means balance 40 rupees is realized profit, which we call it as gross profit. This gross profit will be transferred to departmental P&L account. That's how it will work. Yeah. Next, go to event number C. Event number C. Ascertain gross profit. So here, my difference, it has to be carry forward. Therefore, here, my difference, no entry. For this, really no entry. So for unrealized profit, no entry. Just it's a balance and carry forward. Yeah. Next, ascertain and carry forward hyphen balancing figure in departmental markup account. And transfer to departmental P&L account. Departmental P&L account. So for this only entry will come. So here look out, departmental markup account, whatever balance is there. So this balance will be treated as gross profit and it has to be transferred to departmental P&L. So therefore entry departmental markup account debit to departmental P&L account. Departmental P&L account. This is for GP. So this is for gross profit, GP. Next, let's go to event number D. Event Event number D. So now in a P&L, so already gross profit is transferred. Now whatever expenses are there that I have to debit in P&L account. Thereafter I have to balance. Therefore, next event number D. Recognize departmental expenses in recognize departmental expense in departmental P&L and ascertain net profit, which is balancing figure, and transfer it to in a different general P&L account. That means from a departmental P&L it will go to general P&L. So after recognition of expense net profit, therefore entry departmental P&L account debit to general P&L account. Correct? So this is assuming profit. Departmental P&L account shows the debit balance, so it will go to credit. It will go to. Yeah. So now next let us go to the. So almost these entries are over, my dear friends. So usually this is accounting entry. Now one special transaction is there. So in case of because of this what we call centralized purchase, here one special treatment is there. That's what we call it as event number 5. So special transaction, which is interdepartment transfer. Correct? Yeah, student may raise their eyebrows and they can ask, sir, you said it's a department, it's a centralized purchase, that too we are in departments which are not interdependent. That means there should not be interdepartment transfer. Yes or no? Yes or no? Yeah? Yes. Now look out how it will be. How? Let me show you. Suppose here, let us make this is centralized department. Let us make it as HO. Correct? Let us make this as HO. Now, from here, let us make the department, for example, department A, for department A and department B. Got it? Now, so here it may be 100 rupees is the cost. But when it is transferred to department, imagine it has loaded at 30% margin. Cost plus 30%. That means 130%. Cost plus 30%. Now, same thing. Let us go with the same thing. When the goods are transferred to B, for example, let us make this is at 40% margin. 40% cost plus profit. That is 140%. 140%. So who is recording these accounts? In the books of centralized department, it will be maintained. Now, in each department, my friends, I have to maintain individual stock account respectively. Correct? So like that's 130. Let us keep it as it is. 130. Now look out what happened. Each individually we have to maintain. One is departmental stock account separately. Department A stock account. Correct? So then correspondingly for this department A markup account I supposed to maintain. Correct? Like this also department B stock account as well as department B markup account I would have maintained. Yes or no? So till now, till this, are you clear? Till this, are you clear? Yeah, like this, it would have been mentioned. It would have been recorded like this. Correct, my dear friends? Now here, just suppose if this is a scenario, forget about as of now interdepartment transfer. How it would have been recorded? Let me explain you. Let me explain you. Departmental stock account, since it is purchased, first is when it is transferred, Department A stock account would have been debited with at its margin 30%, 130 at its margin, and markup account would have been credited with 30 rupees at its usual markup. Correct? Now, suppose whatever the goods, if it is a transfer to Department A, it would have been at 140. It would have been at 140, and its mark is 40. Its markup is 40. This is how it would have been recorded in a normal transfer, independent transfer. Correct? Independent transfer. So now imagine, my dear friends. Now imagine here it sells at usually at this price. Now imagine. So this how it will run actually 140, and this how markup will be there. So now here imagine here whatever the stock is there, A has transferred this goods to B. This transfer goods to B. This is what transfer. Correct? So that is different. Physical transfer occurred between departments A and B. Goods. Suppose if one is slow moving, if it is slow moving. Got it? If the goods are slow moving, so from one department, suppose if the stocks are huge is there, what the head office will do? So where it is moving is there you move the stock. Correct? So that movement, what we call it as interdepartment transfer. That is what interdepartment transfer. It's not between one department will transfer to other department at its cost, profit, this and all. Head office is saying that here, so since it's a slow moving goods is there, so therefore another department it is moving. So therefore their stock out is there. Therefore, please here whatever the extra goods are there, take it to that outlet. Correct? That moment what we call as stock transfer. Stock transfer. This is what. So physically stock transfer is between departments. Correct? But my dear friends, accounting, this is what physically stock transferred between two departments. But for the purpose of accounting, you have to record. For the purpose of accounting, you have to record like this. A has returned goods to head office, and head office has supplied this goods to B. This is how accounting has to be done. This is how it is accounting. Are you understanding? This is how it has to be recorded at accounting. Got it? This is how it has to be recorded. So that means, my dear friend, look out. If the goods, same stock, this at 130, imagine complete this stock 130 has been transferred to B. But for B, margin is 140. Therefore, I have to record at independent. Even though physical goods are transferred, so physical goods are transferred departments. But for the purpose of accounting, I have to record as if goods are returned to head office, and from there it was transferred to other department. This is how we have to do it. Correct? So unlike in departments which are interdependent, interdepartment is there. So there physically department will be physical movement of goods also between departments, accounting also between department. But here, since it's maintaining a centralized system, even though physical movement of goods occurred between two departments because of different markups, so but in the head office, I have to nullify as if goods are returned from transferring department and it has been sent to the receiving department. That's how the accounting has to be done. Correct? Now look out how entry has to be done. So now it is, imagine A is transferring goods to B. That means in A, I have to reverse stock. Therefore, departmental stock account should be credited. So simultaneously, I will write the entry, my dear friend. Here, look out. That means in department A, I have to credit 130. That is a stock I have to remove at its margin. Correct? So therefore, entry is how it will come to department A, which is nothing but department A stock account, which is nothing but transferring department stock, transferring department stock account at its markup. At its markup. At its markup. So here keep it as entry amount is 130. 130. Correct? Now imagine in the same way departmental mark account has to be debited. So that means this whatever the departmental markup of A is there, since that goods are transferred, I have to remove that loading. Then only it will tally. It will tally. Correct? So therefore here look out in a debit side. In a debit side, transferring department markup account debit markup account debit. So here which is wait it is transferring department markup. So I will write in for your understanding, I will write department A markup account debit. So here amount is 30 rupees. I have to reverse. 30 rupees I have to reverse. Correct? Now for same entry, same thing, I will record in the books of department B, receiving stock. Correct? So there same amount, this I have to record at, look out here, receiving department at its margin 140 I supposed to record. Correct? So therefore receiving department, so department B stock account at its markup 140. At its markup 140, and department markup I have to credit its loading 40 rupees. This 40 loading I have to credit. So therefore here to department B markup account amount is 40. Amount is 40. Now if you see, your entry will tally. So this also 170, this also 170, this also 170. Correct? So for this technically, so entry I will give here. So thereafter you can copy this example. You can copy this example. Got it? So now let us go with technically entry. So in case of departmental transfer, correct? How entry will come? So first let me write you. Got it? So first is receiving department. For them it is a input of stock, increase in stock. Therefore receiving department stock account debit at its markup price, at its market price, then transferring department markup account, debit. So just it is a markup to transferring department stock account. So this is at its markup to receiving department markup account. Receiving department markup account, its markup. Yeah. So this is how entry will run. Take down. That's all. You what we call department. All theory is over. Got it? So please take down. So this is last special transaction. That's all. Interoffice transfer. Take down. If you have a doubt, kindly ask me. Take down. If you have a doubt, kindly ask me. Otherwise, let us end the session. Friends, are you there? So no response, so therefore just I'm asking. Yes. Yes. So please take up. So we have to reverse at its own loading. Since it is a one department has transferred in department, in a transferring department, stock also I have to remove at its loading. Its markup also I have to remove. Correct? But in the receiving department, at its markup I have to record newly in a stock account, and its loading I have to credit. That's how it will work. Yeah. So that's all for the day, my dear friends. So let's meet you on. Let's meet you tomorrow at 6:30. So departmental account theory is over. So tomorrow problem, let us solve it. So thereafter let's go to the branch accounts. So that's all. So I'll wind up the session. So thank you. So good night to all.